Hello listeners, and welcome to Plugged In, the energy news podcast from Montel, where we bring you the latest news, issues and changes happening in the energy sector. There's been a flurry of activity in global gas markets over the past few weeks, not least the ongoing peace talks between Ukraine and Russia, brokered by the US and the EU. In addition, market focus has been on a potential glut of LNG from the US, the UK pulling financing for Total's Mozambique LNG development, and a war of words between the US's venture global and energy major Shell. But back to the peace talks. This isn't the first round of negotiations we've seen since Russia invaded Ukraine back in February 2022, and so far it's looking like they won't be the last. So how are natural gas and LNG markets responding to the idea of peace, or a lasting ceasefire at least? In this episode, I'll be speaking to market experts about what the next 12 months will bring for the global LNG market, the natural gas market, and the outlook for demand and supply. But first, I'll be speaking to our Deputy Editor-in-Chief, Laurence Walker. Welcome back to the podcast, Laurie.
Thank you, Richard.
My first question would be really, how have global LNG and gas markets responded to these peace talks that we're seeing, or these discussions about peace talks? Obviously, that we're very far away from any kind of deal.
Yes, I mean, obviously, as you say, there still seem to be some way away from reaching any actual deal, but certainly played into sentiments. Prices have dropped considerably. I think we're at the time of speaking around the lowest since April last year. So we're below 30 euros a megawatt hour. Speaking with people on the market, potentially, if there is a deal reached, we could see prices drop even further, even to 20 perhaps, or below 20. This does reflect some reduction in the risk premium, but I guess for the time being, it's not going to have any major impact on supply demand if there is a deal. I think what people are looking to is perhaps a possible return of Russian flows and how that would impact supply, and also perhaps Russia stopping its strikes on gas infrastructure in Ukraine, these sort of things. But it's very much sentiment driven, and I think also we have to bear in mind what's been playing into these price losses has been things like a relatively mild winter so far. The demand hasn't been terribly strong. We've had record US LNG imports last month, and overall LNG imports to Europe, I think, about an 8-month high. So there's no shortage of supply as well. So obviously the peace talks, but also other things.
There's a plethora of factors maybe contributing to that slightly softer prices, which is obviously a welcome state of affairs after all the spikes and the very high price levels that we've seen in recent years. Now, I want to focus now, Laurie, on a story that you basically drove forward, a Montel investigation that uncovered the likelihood that Russian gas has been blended into supplies going into the UK via its interconnections with France and Belgium. Can you explain what's happening here and what loopholes it shows in the current system, or what flaws it shows that currently exist in the interconnected gas market?
Yes, I mean, it certainly shows the complexities of sanctioning gas. I mean, what we've found in this instance, I mean, the UK banned the import of all Russian gas in 2023, but mainland Europe still imports Russian gas and predominantly LNG. These cargoes arrive at European ports, then they get mixed into the gas system, and once it's gone in there, there's no way of knowing, obviously, what proportion is of Russian gas. There's no sort of monitoring as such. Therefore, this blend can be exported via interconnectors. So we have interconnectors with Belgium and the Netherlands, and while there hasn't been a huge amount so far this year, these sort of flows do tend to pick up over the winter months when we need more supply to meet heating demand. While it's obviously maybe not new news as such that the gas gets blended, what I think is important is that we've spoken with people all the way along supply chains, so people from pipeline operators, sanctions lawyers, traders, regulators, cargo inspectors, and obviously even the government, all really have just confirmed that these sanctions are there, but there's no real guidelines. So as such, no one's really taking responsibility to enforce what's flowing into the UK, what's going on, and the authorities in effect seem to be sort of passing the buck, I'd say, in terms of responsibility.
You mentioned other European countries. Is this an issue elsewhere? And do you think that we'll see countries turning a blind eye to Russian imports and countries blending them into their own supply chain and sending it out all across Europe?
It will certainly, I mean, what we're looking at with the UK, it's sort of a focused point. The UK is one of the only countries which has sort of done an outright ban on Russian gas so far. So in Europe, yeah, they can still blend the stuff. It's still legal to do so. Yes, the problem will come beyond then. And I think the concern is that if the sort of UK sanctions and the way they're being dealt with, the way they're being policed, monitored, is going to be a kind of a blueprint for the rest of Europe, I think it's going to be, you could easily see gas from Russia continuing to leak in, via the Turk Stream, through Turkey, through other routes. And also in terms of monitoring the LNG. And I think there are big concerns about, once an LNG car goes out on the water, or it gets moved, or there's a ship-to-ship transfer or something of this sort, again, it's very harder to monitor. I mean, we've looked at sanctions on other commodities in the past, like coal, biomass, where it's a lot easier to track. They have more of a footprint as they go. Gas is a difficult beast to track, and as a result, people don't seem to be making an effort to find a way of enforcing it there. And I think that's the problem. It kind of comes to the stage where it becomes not so much a reason as an excuse, I'd say.
Just a final question, Laurie. The guests in the main episode, they talked about the price for gas in dollar terms, and you mentioned euros per megawatt hour. So if you say 30 euros per megawatt hour or 20 euros per megawatt hour, what's that in dollar terms?
Well, I mean, 30 euros megawatt hour would be something like around just over $10 MMbtu. So 20, we're kind of looking at sub 7, sort of $6.8 or so.
A metric million British thermal unit, is it?
Yes, that's it. Yeah.
MMbtu.
Yeah.
Thank you very much, Laurie. Very, very helpful, and thanks for setting the scene for us.
Thank you, Richard.
Now, I'm pleased to welcome back two of our regular commentators to the podcast. Henning Gloystein, Managing Director of Energy and Resources at Eurasia Group, and Saul Kavanagh, Head of Energy Research at MST Financial. Warm welcome back to the podcast, guys.
Great to be with you. Good to be back, James.
I thought I'd start off, Saul, by asking you about sort of the current sentiment in sort of global LNG and, by implication, the global gas market. So where are we at the moment?
Well, the context would be, obviously, the market spiked significantly in the wake of the Ukraine war in 2022, where Russia turned off the taps to most of the gas into Europe. That saw Europe suck a lot of LNG away from the rest of the world, including emerging Asia. And there's not been a lot of new LNG supply that has come online since then. And so the market has been reasonably tight over the last 3 years. And it's obviously come down off those very lofty peaks in 22, but we're still seeing prices hold up essentially above $10 to this day. Now, the outlook is a bit different because we're starting to see a very significant ramp up of supply from both Qatar and the United States, beginning in 2026, but particularly in earnest from 2027. And that pace of growth is forecast to outpace the growth in demand. And as a result, we're expecting softer prices. I think where an element of strong debate will be is, what does soft prices actually mean in dollars and MMbtu these days? Because the last time we saw a significantly oversupplied market was 5 years ago, and a lot has changed since then. But I think from a market perspective, everyone is wondering on how much oversupply will eventuate, what does that mean for pricing, and how long will that last, given United States continues to take final investment decision on new projects, regardless of this softer outlook.
Absolutely, and higher domestic gas prices as well in the US. But what's your view on demand in Asia? So what's the outlook there for the winter months?
I mean, a lot of it's obviously just going to be dependent on the severity of the winter. I think what's the most interesting debate at the moment is, if we do start to see LNG prices drop below $10 towards 9, 8, potentially lower, do we see a strong demand side response, particularly from emerging Asian economies? And I think that's now, we can do academic kind of studies on that, but the proof is in the pudding, so to speak. And all that demand, that was essentially the demand destruction that occurred in Asia as a result of Europe's thirst for LNG in 2022. A lot of that still hasn't come back. And the question is, does it come back? Is there latent demand there, which can mop up a period of oversupply and actually prevent or at least shorten a period where you would have supply response out of the US, which essentially entails much lower pricing points? And I think the answer to that question will determine if a weak price outlook means $8 or if a weak price outlook means $5 on a year average in, say, 2027 or 2028.
What's your view on the JKM, the Japan-Korea marker, and the TTF, the Dutch gas price, the winter spread? What's your view there, Saul? Do you expect that to tighten or widen?
For this coming winter?
Yeah.
Oh, we're in winter, I guess, already. That's just started. Look, things should be able to be, again, dependent on a few factors, and particularly the severity of the winter, and obviously the geopolitical environment with Russia and Ukraine in particular. But it should be, things look like they're reasonably under control, despite, stocks haven't been forced to the higher levels they were in the last few years. So if we get a very severe winter, and Henning, tell me if you disagree with me, but I think we could see prices then be maintained in the teens. But, we're talking about, an upside is now in the teens, which compared to the last 2 years is not really that high. And if we see a relatively weak or mild winter, that's going to leave us with quite strong stock levels exiting winter ahead of new supply ramping up again out of the US and Qatar next year, which would be kind of bode for, potentially prices dropping into single digits potentially in the shoulder months of 2026.
No, I mean, any comments, Henning, there on what do you agree generally with Saul's outlook here for the coming months?
Yeah, Saul and I, we don't always agree on things, but I have shocking agreement here. So we actually have a price range outlook. We try and avoid the term forecast, but it is what it is. So, but for 26, 27, where you would think so, the price floor is actually $7 per MMbtu. Which would sit in the middle of what Saul has just said. Now, I have recently come across quite a few people who say, no, 5 is much more likely now because of so much US LNG coming to market, and that they've already sunk most of their costs, so that, rather than shutting in production, they just to continue to send to Europe. But there's two things in Europe that I think are worth considering that might change the dynamics this winter. One is Germany. Their inventories are pretty low. They didn't fill up. They only went about 70-something% at the start of winter. So if this is a cold and long winter, then Germany could, I wouldn't say it's a problem. They wouldn't run out of gas, but that would raise prices because they'd have to go into the spot market to prevent inventories falling to pretty low levels, which they want to avoid. And the rest, I guess we'll come into a minute, is what's going to happen in Ukraine this winter. That's quite a crucial development that's really difficult to forecast.
If we stick with the Ukraine, and there are ongoing talks at the moment, the US, Europe, and Russia and Ukraine, obviously. What's the view from Eurasia here? How likely is a peace deal, Henning?
So a peace deal, in the sense that it's credible and lasting, we think is very unlikely in the near term. In fact, right out towards the middle of 2026. Our current house view is that it's even unlikely that a credible, stable ceasefire comes out of these talks. Now, I have to caveat that things are moving quite fast. 3 weeks ago, suddenly the US initiative that was apparently part written by the Russians came out of seemingly nowhere. So at least the Ukrainians and the European Union didn't know about it, and neither did the UK. Then that was written a little bit and put back to the Russians, and they said no to it. So there's a lot of movement right now. There's talks this week ongoing between Steve Witkoff, the US envoy, and the Russian government. So there's lots going on. But essentially what we're seeing here, what we think is, we're seeing in live politics the lack of Venn diagram overlap. If you remember what the US produced 3 weeks ago in collaboration with the Russians was totally unacceptable to Ukraine, and for that matter also to the European Union and the UK. And then it was rewritten a little bit, and then that was given over to the Russians, and they said absolutely unacceptable. And that tells you that both sides at this stage prefer fighting another winter. This is why we don't really think there's a credible ceasefire coming out. It's possible that you suddenly see something like, okay, we're going to literally have a cessation of firing, which I guess is another term for ceasefire. But But that would be so unstable. You'd basically see both sides just stopping to shoot for a few days, rearm, restructure, remove a little bit, and then at a very high risk of either side trying to take advantage of the situation and just push ahead again. So unfortunately, we're pretty sure that we're going to have another winter of fighting in Ukraine.
What's your view here, Saul? I mean, would you agree with Henning?
I would be very wary of disagreeing with Henning on this. Henning's almost expert on this topic, at least as regards to energy. I think, particularly because I'm starting to focus a bit more on the midterm than on the very short term. We've read an environment where, with ESG and climate pressures, really since 2020 through 2024, appetite to invest, in big LNG projects and things has been kind of diminished. That has really turned around this year. It's turned around in the last 6 to 9 months. There's a lot more appetite to invest. There's a lot more bullishness on the overall outlook for oil and LNG at a global level. And what I think is very interesting is, let's assume, let's look at a bearish scenario. Let's assume some kind of sustained ceasefire, perhaps like imposed by Trump, is achieved at some point next year. And what does that mean? Does that mean that all of a sudden the Russian gas starts flooding back into Europe and we see an oversupply? Or more realistically, is Europe likely to still be very wary you're taking much more Russian gas? And so actually the balances are left relatively unchanged. I mean, particularly good considering Trump's not really seems to be enforcing sanctions on Arctic 2. So those volumes are coming back kind of come what may. I think we need to look at a scenario which says, even in that really bearish scenario from a pricing perspective, it's not really such necessarily the biggest driver for gas prices over the next several years. The biggest driver is going to be a lot about execution and timeframes of the US projects, and are they actually delivered on schedule, which I'm very skeptical of. And this demand side response. And what I think is the most interesting thing. So in the last 5 years, we've had 2 major black swan events for gas markets. We had COVID, and then we had the Ukraine war. And as a result, in a market where ultimately there's particularly a lack of transparency on the demand side, we always used to, as analysts and forecasters, we're always measuring our numbers relative to the year before. And the truth is we had these 2 big shocks in the last 5 years. It's very hard to do so. Everyone's models now have a much higher margin of error, particularly on the demand side of what things look like. And if you recall, 3 or 4 years ago, the long-term outlook for LNG prices into Asia was around the $7 to $9 an MMbtu range, depending on the forecast. Now we're talking about a world where even in a large oversupply scenario, as Henning said, there's a forecast of $7 on annual average. So what used to be the mid case is now the record oversupply floor case. And what does that mean for the mid case for LNG prices going forward? So consensus is still around $9 to $10, but I think we could start to make a case that perhaps it's more like $10 to $13. And the ramifications of that, both for energy prices, but also for the viability of new LNG projects, I think is quite profound and is not being discussed enough these days. Keen to get your challenge on that, Henning. I'm hoping you disagree with me so we can have a debate.
Yeah, over to you, Henning. I mean, especially on the demand side, what's the outlook for demand in Europe for gas?
All right, I'll try and disagree very politely. So what could put this sort of pressure downward further? On the one side, so if you start in Europe, at the moment, of the German plan that was announced earlier this year to build 20 gigs of gas-fired power stations by 2030. Now, we always said that was a little bit overambitious. We kind of said, maybe they can do 12 to 13 gigs by 2030. Now turns they're going to do 8 gigawatt between 2028 and 2031, which I don't think they'll do much by 2028. So it's going to be towards the tail end here. So on the demand function, Europe's biggest economy, Germany, is not going to add as much gas as we thought, just gas consumption as we just thought, or they thought just a few months ago. And I think that's probably similar across Europe. If you take the other big gas consumers like Italy, for instance, not much going on in terms of new consumption there. unless you factor in an enormous economic revival, which we really don't think so. I'm often accused of optimism in the sense that I'm not catastrophically bearish about Europe, but I really can't build you a scenario of explosive industrial gas consumption in Germany or elsewhere in Europe at the moment. So I think that's a little bit that's going to keep the market sort of drag on prices. And then if you move over to Asia, there's obviously the two big ones. There's China and India. China, I think, is approaching a peak in fossil fuel imports. I think probably in oil has already happened, and now natural gas is the next one. And that in particular hits the LNG market for two reasons. Like, might be that the gas consumption overall remains high because they're pushing their domestic production. They're building power of Siberia 2 now, and they will build it. So the pipeline to Russia, and they're trying to cap LNG imports at 50% of gas consumption of every Chinese utility. And that is for geopolitical reasons. The Chinese government is really worried that in case it comes to a sort of a showdown with the United States, that trade in the South China Sea is impeded. And then if you look at China's biggest LNG suppliers of the past, it has been the United States. It's not anymore, but it was the United States and two of its biggest allies, Australia and Qatar. So they are really worried about that situation. And then you're seeing the electrification that's going on, which is now hitting the truck market, so the heavy goods vehicles, where China has been using a lot of LNG in the past, but they're shifting to electric trucks really fast. And then India is so price sensitive. I talked to a major Indian importer of gas LNG a few weeks ago, and he basically said, unless you can get an average LNG spot price of $7 to $8, we're going to wipe out LNG for power generation in India because we just can't afford it. It's too expensive. And then they're worried about geopolitical events like the war in Ukraine, 15 years ago, Fukushima in Japan, or it just gets cold in China. There's all things that don't affect India, shouldn't affect India, but they do. So they're really wary of it. So if you put all that together, I struggle to believe the LNG demand forecasts, the bullish ones that are out there at the moment. And that, in conclusion, would be my push back towards Seoul.
I think that was a very low-key disagreement there, Henning. But just a question on before I turn to Seoul. I think with that 8 gigawatts of gigawatts of German gas plants coming online by between 2028 and 31. I mean, these are not baseload plants, are they? So they're going to be peakers. They're going to be balancing the grid, balancing the times, our old favorite, the Dunkelflaute period. So I mean, there's not going to be that huge amount of demand coming from them as if they're running 24/7.
Exactly. So yeah, even you're adding to the pushback here. So
yeah, sorry. Okay, on to you. So I'm just interested. You're welcome to push back on the pushback. So, but just before potentially you do that, I was interested in your comments on your doubts about all the US LNG coming online. Why are you a bit skeptical there?
So a big change, really, particularly from this year and the new projects, including recently Venture Global's Calcasieu Pass 2 and the projects that may take FID going forward, is the EPC capacity of the LNG sector has now been largely exhausted. It's still decimated from the levels it was during the boom 10 to 15 years ago. You don't have anywhere near the capability and breadth of large contract sectors as you used to. And what you're seeing now in the United States, unlike the previous 2 LNG waves, is US LNG EPC contractors are no longer willing to wrap on lump sum turnkey their projects, right? And that is a very big change. And the reason they're not willing to do it is because it's too risky, right? And this was happening before Trump's tariff war. So this wasn't being driven by that. But certainly the tariffs had exacerbated that risk profile. And so what you're seeing now is when they announce a project, that's not guaranteed by Bechtel to be up and running in 4 years. It's now all the risk still ultimately is now lying with the operators. And so it's not just your supply chain and labor cost environment, which is posing risks, but the whole structure of these EPC contracts is higher risk. And I would think you were more likely to see these projects now being delayed. if you look, it used to be, back in the heyday of LNG a decade ago, you had Bechtel and Chiyoda, Worley, JGC, Technip, all these companies were quite heavily involved in the EPC space. Now, Bechtel's still tier one, but you've seen Chiyoda really scale back and have some problems, for example, in Golden Pass. And even Qatar, I think, is going to be, 6-9 months late on, as things currently are. Other teams like KPR, JGC significantly downsized their teams and haven't really come back in the same way. Worley is now getting back into the market, which is a sign that they actually see that there's a shortage. And so I think these are all telltale signs that things are more likely to be difficult for the next wave of projects coming out of the US. And if that means when you're getting this big ramp up in supply, right? If these things end up being, say, on average 6 to 12 months late, that tightens your balances 20 to 30 million tons per annum over the next 4 to 5 years, which is, quite significant. And so I think that's, if we see that play out and we see emerging Asian economies pick up demand, if LNG goes to $8, say, so there you could see another 20 to 30 million tons of demand response. All of a sudden, that oversupply of 50 million tons doesn't exist. You don't end up pushing out a lot of US LNG, and your annual average price could be $7 to $8, even in a really weak year. And then everyone has to revisit what the ultimate cost and pricing structure for LNG is going forward. I think I'll just add lastly is, now, I obviously like to focus on Australia because I'm from Australia, but Australia has been a very good kind of canary in the coal mine for energy transition around the world because we've had such rapid coal closures, high penetration of renewable, high volatility as a result. And what we see in Australia now is the impact of AI and sovereign data centers on electricity demand is pushing up electricity demand several hundred basis points over the next 5 years. It's already done at a couple hundred basis points. And when you have what's relatively quick increases in demand from a new sector like that, gas tends to pick up a lot of that slack. To the point that now the government has shifted here in a big way, realizing we need a lot more gas support. Otherwise, we're going to be holding back our technology ambitions. And so if you start to apply that at a global level, which is a very apt thing to be doing, if you say electricity demand is going to actually be 5% higher in 2030 just because of data center demand, what does that mean for your power mix? And a lot of that incremental is likely to be coming from gas or nuclear if you have it. And that impact on LNG actually can be quite significant. Just to provide that counterbalancing what's kind of could be an upside pressure, which is again not baked into the base case forecast at this point.
Yeah, that's fascinating stuff, Saul. I think just finally, I'd like to go back onto sort of Russia-Ukraine issues here. I think we're still seeing moves to strongly, end Russian gas and Russian imports of LNG by 2027, despite some countries, some member states kicking back against that. What's your view here, Henning? Do you think it's likely that 2027 will see the end of all Russian gas to Europe?
So early this year, I had still had the position that at some point when a ceasefire comes, for instance, pipeline supply from Russia via Ukraine into the landlocked parts of the EU, so Slovakia and Hungary in particular, would resume. I don't think that anymore. I'll get that in a moment. But then, of course, you've got the LNG sector, where at the moment that is the policy that Europe wants to phase it all out. And we'll have to wait and see on that. I think that still will become part of negotiations. They're low-hanging fruit when things are negotiated between Russia, Ukraine, and the Europeans and the Americans, of course. That might become a play ball. But the volumes will be low. Europe doesn't really need Russian gas at high volumes anymore. It's 3 years ago that this all started. A lot has changed since then. And it's just the need for high volume gas imports from Russia is gone. On the pipeline side, I think it's one really important thing to keep in mind is Russia has over the last 2 months taken out the entire power system of Ukraine. I actually don't think this has ever happened, that a nation's taken another sovereign nation's entire power system, civilian energy system, out so systematically. So they've taken out more than 40 coal and gas-fired power stations, and they've also taken out 60% of Ukraine's natural gas production. Now, the Ukrainians are making heroic efforts to repair this as they're being bombarded, but obviously that doesn't really work. So it's an emergency fixing measure, and the gas production is near the front line, so it's being shot out all the time. So this means that the Ukrainian power and gas system will require imports from the European Union over the next couple of years. Even if there was a ceasefire next winter or this winter, this would take a couple of years to fully repair because the damage is so extensive. And that means on the electricity side, they're going to have to import power from Poland and from Central and Southeastern Europe. But on the gas side, LNG will have to be coming in. We already saw one cargo coming into Greece and being put northward, and then there'll be more cargoes into Lithuania and Poland. The estimates that I heard when I was in Ukraine was that between 4 and 6 BCM between now and March will be needed, and roughly 10 BCM per annum over the next 3 years, 3 to 5 years. And that goes a little bit towards what Sol was saying. This is an incremental increase in gas consumption that wasn't there just very recently. And then if things get cold, or if the economy in Europe does do a little bit better, this is indeed important, because you're just shifting everything a little bit further, and gas is a marginal commodity. So it does react really sensitively just to these moderate swings, because all of this gas will have to be bought in the spot market, and then you start fishing around, where is it coming from? And so that could tighten things, because especially the situation in Ukraine, it cannot be resolved easily. And lastly, will pipeline gas flow back from Russia to Central Europe? We think not, because the Ukrainian officials were talked to saying, like, after this extensive systematic damage of Ukraine's civil energy infrastructure, you cannot reward Russia by allowing Russian gas back into the parts of the European Union that would being the most pro-Russian. So some officials said, like, even if this was agreed overhead, we'd just sabotage the lines. So we're not going to allow it. So I think that,
Absolutely. Thank you, Henny. I mean, I think that's very, very clear. But I think Montel was recently reported, Saul, I know you're not an engineer, but, despite some countries clearly banning all Russian gas, pipelined and LNG from Russia is still flowing into France, Belgium and Spain. And a recent Montel report highlighted the fact that there's highly likely that Russian gas being blended on the continent will flow to the UK. It's already flowing back into Germany. I mean, is it possible to track the molecules of Russian gas versus other gas, or is this just something that we can expect to happen, especially in periods of tightness over the winter?
Well, Richard, as it turns out, I am an engineer, but I'm afraid doesn't actually help me answer this question any particularly.
Okay, sorry. Mea culpa, Fizzle.
So look, there's two things to that. So there's limits into what you can ultimately track and trace, but you can do quite a lot more than is currently being done. And that then comes to the second point, which is, how much do you really want to know? Right. We're seeing a lot of Iranian barrels and Russian barrels on the market, which are not supposed to be. And it's well known, the intermediate countries that they're going through, and people have been willing to turn a blind eye under the Trump administration, under the Biden administration. So it's a question of will, I think, more. You could be weeding out a lot more if you wanted to. But that, it's a question of if they want to. And I mean, a lot of it comes back to, if we remember, the reason Europe stopped taking Russian gas was not because Europe made a principled decision not to take Russian gas. It's because Russia turned the gas off. And I tend to agree with everything that Henning said, but I do worry that after some kind of ceasefire, if it lasts for a period of time and a few years passes and that cheap Russian gas is there and it's cheap, will Germany say, we'll take a little bit more the year after. And in 10 years' time, we have probably not to the same extent but before, but at least a degree of reliance on cheap Russian gas. And history would suggest that it's a pretty high likelihood of playing out over time, because memories end up being short when there's a cheap option on the table. And I say that it would be unfortunate if that happens. But, I think particularly from a 2030 onwards perspective, if we just want to look at this from a market balances perspective, would be one of the downside risks. It's again, not in a base case, but it would be a downside risk to prices. That's some more material Russian flows come back into Europe.
Gentlemen, I feel we could talk for hours on this, but we have to put a stop to it now, and time is running short. So once again, a fascinating discussion, and sure one to be continued in 2026. So thank you very much for joining the Plugged In podcast.
It's Richard. Thanks.
Thanks, Henning. Thanks, Richard.
And you listeners, thanks for listening to this episode of Plugged In. If you enjoyed this discussion, please like, rate, and follow to make sure you get the latest podcast episodes as soon as we release them every Friday. We'd also love to read your reviews of the podcast. It helps us to keep up to date with what you, our listeners, think of our podcast and what content you want to receive more of. Finally, you can head to montelnews.com for more news and analysis from our team of journalists across Europe and beyond. See you next time.